Hello everyone. In this session I am going to talk about the evolution of stress testing of the counterparty exposures, wherein we are looking at some of the key terms, different definitions of what is meant by current exposure, potential exposure, expected exposure, a few of the terms, and then we will move on to counterparty credit risk. How is it typically treated? Sometimes we treat it as a credit risk, whereas in some cases we treat it as a market risk, whereas in some cases it can be treated as a combo. So how is it typically treated? And depends on how it is treated, whether it's a credit risk or a market risk, what are the typical implications we are having. So that's one aspect that we are talking of. Then we move on towards doing stress tests. One on a loan portfolio, two on a derivative portfolio. So how are the things different? Especially when I want to do a stress test on a loan portfolio versus a stress testing on a derivatives portfolio, what are the key differences in between these two mechanisms? How do I compute the stress loss in both these scenarios? So that's one point we are going to talk of. Then we are bringing in the credit value adjustment, especially adjustment in the value of the portfolio because of the possibility of a default of a counterparty. So how do I really compute the CVA first of all, and how do I really do a stress testing of the CVA, and how do I compute the stressed loss on a credit value adjustment value. Similarly, if I am getting into a bilateral credit value adjustment, wherein I am considering not only the default of the my counterparty to me, but also I am looking at the loss that is coming because of my default to my counterparty. So that is where I am also bringing in the debt value adjustment DVA, which makes the overall CVA deal a bilateral CVA agreement. And finally, we will be looking at what are the common pitfalls in the entire stress testing of the counterparty credit risk. So just talking about a few terms, we need to clearly differentiate what is current exposure. So let's say we are talking about two parties, A and B. A is a financial institution which has a lot of contracts, agreements with B. B is the counterparty of A, correct? Now let's say B is defaulting. So this is where we call A is having a counterparty credit risk, right? But here you see A and B have three transactions. Now, when I'm saying current exposure, I'm talking about at this moment, if B is defaulted, right? At this moment, if B is defaulted, assuming that there is no recovery from B, what is the total loss for A on all the three transactions taken together within a netting set? So even after the putting of the netting, what is the total amount of loss for A because of default of B? So if it is negative, I'll treat it as 0. If it is positive, I'll treat it as the positive value itself, because if it is negative means actually when B has defaulted, A has to pay B. So A is not having any kind of an exposure there. But if B has to pay A and B has defaulted, that is where we talk about the exposure exists for A because B is defaulting and A is having a loss because of the B's default. So across all the transactions taken together, along with the netting also considered, I will try to find out what is the amount of loss that A is going to incur provided B is defaulting right away. So that is what we call as a current exposure. In some cases it's also called as the replacement cost. Whereas when I say peak exposure, we are going into the future. It's not about the current. So we are trying to simulate, okay, 1 week down the lane, 1 month down the lane, 2 months down the lane, 6 months down the lane, up to the longest maturity date of the transactions in the netting set. So there are 3 transactions. This may be a 2-year transaction, this may be a 5-year, and this may be a 3-year. So up to 5 years, I'll try to compute this peak exposure for different dates. Now what is this peak exposure? I'll try to find the expected exposure, right? I'm trying to look at the distribution of how exposure could be lying at a future date. What would be the exposure? Not of today. If the exposure is of today, we are calling it as a current exposure. But I am not computing the exposure as of today. I would be computing the exposure on a future date, right? So, and accordingly, I will find out what is the 95% value or a 99% value, which means what is the chance. See, I want to be 99% confident that on that date in future, the exposure will not be greater than this particular amount by more than 1%. There is only 1% chance. There are different ways of putting the same. There is only 1% chance that the exposure on that particular future date will be more than this particular amount that we are determining. The chances of that occurring are only 1% or below. So that is what we are calling as the expected the peak exposure. So there is hardly a 1% chance that the exposure will be more than that particular amount. Similarly, the next term that comes in here is the expected exposure. Now I have got the graph of the exposures. Now this is what is the 99%. So I am saying this is my peak exposure. But the same exposures I am trying to find the 50%, which is the mean, right? Which is the average of all those exposures. And so once you find out the exposures, once you simulate, generally this entire thing can be done through simulation. Once you simulate all the possible exposures, when I find the 95 or 99% confidence value of the same, we are calling it as a peak exposure. When I am finding the mean value of that, it is called as an expected exposure. Now let me tell you here, the exposure wise, it's always either a positive value or it is 0. I will not consider a negative value here at all. Negative value means I have to pay to my counterparty. I am not having any kind of a loss from my counterparty. So if the exposure is coming out to be negative, I'll take it as 0. I mean, if the net of all transactions is coming out to be negative, I'll be taking it as 0 but not as a negative value. And there is one more definition, which is expected positive exposure. Now we have got so many exposures out here for each of the transactions. I'm taking the weighted average of all these expected exposures over time. So for different time periods, I'm trying to find out what is the expected exposure. I'm taking the weighted average of all those times, and that is what we are calling as the expected positive exposure EPE. So we have to be very careful in terms of having an understanding of all these terminologies, and we should not be confused in terms of using them. interchangeably. They can't be used interchangeably. They have a definite meaning associated with them. Then, the treatment of counterparty credit risk. So we know counterparty credit risk means the risk that is coming because of the possibility of the default of the counterparty, right? So obviously it can be treated as a credit risk. But in some cases there is a treatment as a market risk as well. So by default, you can treat it as a credit risk. So once you know it's a credit risk, we are trying to find out various potential exposure models. What is the kind of an exposure that can come out because of this loss occurring? Because of this particular risk, what is the loss what could be the potential loss to the counterparty? So we are able to measure that exposure and we are able to even limit the counterparty risk. And because these models based on potential exposure are adapted to, we are based on the potential exposure, we are also going ahead with expected positive exposure, right, where we are taking the weighted averages of the expected exposures to come out with expected positive exposure. So because of that reason, even in case of, even just like the way we are treating the loans, the counterparty credit risk with respect to the loan, we can also treat the same way counterparty credit risk associated with the derivatives as well. Because we are only considering the positive values. The negative values do not exist out here, or we are making them as zeros. So we can very well treat the loans and derivatives more or less in the similar manner. And to a large extent, between 2000 and 2006, the counterparty credit risk was treated as a part of a credit risk itself. So that kind of an assumption was one of the major bases or the frameworks for managing the counterparty credit risk during the 2000 to 2006 period. And during this process, almost everything to measure the counterparty credit risk, almost all the things which are reducing the credit risk, credit enhancements like netting, margining, all those have been taken into consideration while computing the counterparty credit risk when you are treating the credit risk, counterparty credit risk as a part of the credit risk. But what has been observed during the financial crisis is there is a very heavy possibility of a wrong way risk. Because if you look at the counterparty and the credit quality of the counterparty versus the exposure, they are getting very much correlated. So there is a very clear-cut possibility that when the counterparty is defaulting more and more, there is a chance that the exposure is also increasing. So these are not independent. When I look at the exposure, when the counterparty is in a normal scenario, the exposure is much lesser. The amount that I would be losing is much lesser. But when the probability of default of the counterparty is increasing, at the same time the exposure that is at default is also increasing. Now that is what we are calling as a wrong way risk. That's a kind of a correlation, which means, see, generally when the economy is good, I don't bother too much. Whatever the collateral that I have taken from the counterparty is sufficient. But when the counterparty starts to default, means generally assume that when the economy is bad, the counterparty also position is also bad. So he starts defaulting. So when he is starting to default, there is a possibility that because I have a collateral with me, I can very well recover the loss of the collateral default, the counterparty defaulting by considering the collateral. But it is observed that the value of the collateral also falls quite drastically during that same period because of the correlation that is existing. So which means if I want to sell off the collateral and get a compensation for the default of the counterparty, what I am getting is also negligible. I would not be able to recover the whole loss amount based on the collateral that has been provided by the borrower. Now this is where we are understanding that it's just not a credit risk that has to be considered for counterparty credit risk. There is an element of market risk also is coming into picture because of the identified wrong way risk. So up to the crisis, the way the market risk has been incorporated into the counterparty credit risk is for the valuation of the credit valuation adjustment CVA, and especially during before the crisis, because the credit spreads were more or less stable, CVA was a very small amount of the value of the portfolios of the banks. So that way it was almost a neglected kind of an amount. So people did not bother treating counterparty credit risk as a part of a market risk at all. But during the credit crisis, we have seen that the credit spreads have widened, and the credit spreads are widening, so the possibility of the default is increasing, but at the same time the exposure amounts also were increasing quite drastically. There was a lot of volatility among the exposure amounts as well as credit spread. None of them were stable. So there was a possibility of large losses that came out, which is a clear-cut pointer that you need to treat counterparty credit risk not just as a credit risk alone. It has to be treated even as a part of the market risk, because the value of the credit valuation adjustment might swing quite drastically because of the presence of wrong way risk in the process. So depending on the way the counterparty credit risk was treated, there are some implications on trading activities as well as on the risk management aspect. So even if you treat CCR as a part of market risk or you treat CCR as a part of the credit risk, you can very well use it for the management of the portfolio. But I cannot just focus on one of them and ignore the other one. For example, if you treat counterparty credit risk is a credit risk, not a market risk at all, you ignore the market risk part. Means, yes, against the credit risk, I have shielded myself by taking some collaterals or something. But what if the value of that collateral goes down quite drastically? Now this means there is an exposure that is coming up because of the changes in the credit value adjustment, which is mostly a market risk related factor. So I am able to set all my exposure limits, right? I am managing the default risk. I have set collaterals. I have pulled in netting. I have brought so many things to manage the credit risk. But what if the value of this credit value adjustment changes? Right? So there is a market risk element in that altogether, which I cannot ignore. If I am ignoring it, obviously I am losing out. So the exposure is not fully eliminated. I am still exposed to the changes in the credit value adjustment. Similarly, if I am treating counterparty credit risk as a market risk, so I'll try to hedge the changes in the CVA. So the CVA I am reducing, the changes in the CVA the risk I am reducing by doing a hedging, right? So the market risk related losses are coming out, but what if the credit worthiness of the counterparty is getting badly affected? One of the counterparties defaults very badly. Now I am trying to protect myself only against the changes in the CVA, but I did not bother much about the possibility of default of one or more counterparties. So there also my overall exposure is in full, which is an indication that I have to take care of both the counterparty credit risk for me needs to be looked at from the perspective of credit risk as well as from the perspective of market risk. Then the same thing, CCR treatment from the risk management perspective. You look at, if you start looking at CCR as a traditional credit risk view, we know that the credit of the counterparty can be managed at the beginning. We keep collateral. In the middle also we can keep asking collateral. Whatever is the collateral advance that we have set up in advance, only based on that agreement that we have set regarding the collateral, we can handle the credit risk. That is what if I start looking at CCR as a pure credit risk. Once the trades are in place, there is nothing that I can do. So when the counterparty has defaulted, I have to replace all those trades in the market at once, which may not happen. So there is the possibility of market risk that is coming out in the process, and I am still at a loss. But when I am treating counterparty credit risk as a market risk, there is a hedging process that is coming in. So even before the default, I can go ahead and do a hedging. So the entire counterparty credit risk I can hedge. I don't need to replace the contracts until the default has actually occurred. So before the default has occurred itself, I can get into the buying the positions based on the probability of default of the counterparty. So that way I really don't need to wait until the default is occurring. So risk management becomes more and more effective the moment I start looking at counterparty credit risk as a market risk rather than just looking at it solely as a part of the credit risk, right? Now, the next thing we are talking about is stress testing. We are taking two examples. One, stress testing on a loan portfolio and a derivative portfolio. Whatever it is, you first analyze how the expected loss would change under a stress. That is what is the stress loss computation. How the expected loss would change in a stress. So basically the objective is to look at the unconditional expected loss. So because of a possibility of stressing, what is the kind of unconditional expected loss that is coming across the pool of counterparties, which means the loss I'm more looking at, if I'm talking about a stress loss, I'm talking about the expected loss that I'm getting under stress versus expected loss that I'm getting when there is no stress. So we know normal expected loss is nothing but I multiply for each of the counterparties, I take the probability of default of that particular counterparty, the loss given default of that counterparty, I also multiply it with exposure at default of that counterparty. Now this probability of default actually is the marginal probability of default during that particular period, multiplied by the loss given default multiplied by the exposure at default. Now, on a loan portfolio, I am taking the exposure at default that will not change quite drastically. So I am here taking a credit risk perspective. So my exposure at default is more or less fixed. That is equal to the amount of loan that I have given to the counterparty. So the loss given default also I am taking it as deterministic. Only the probability of default I am stressing out here. When I am treating counterparty credit risk as a part of the credit risk, so exposure at default, we are not changing the exposure, we are almost freezing the exposure value. It's only the probability of default that is going to change. Now the probability of default can be based on various aspects, probably based on the exchange rate, the probability of default could change. So I'll link it to some kind of a market variable. Either unemployment rate could impact probability of default, or probably the company's own balance sheet items also can impact the probability of default. So based on that changed probability of default, you compute the stressed expected loss. So this might not change, this might not change, but keep changing this number. The probability of default, the marginal probability of default from period T to T plus 1. Based on that, you compute the stressed expected loss. Right? Keep changing, keep stressing the market variables which would impact the probability of default, and based on that you compute your stressed expected loss. The difference between these two is what we are calling as a stress loss. Now this stress loss can be computed for each individual counterparty separately, or even I can compute it at an overall portfolio level as well. But in this process, we are considering the counterparty credit risk as purely a part of the credit risk. We are not looking at it as a market risk here. But when I talk of it in terms of for a derivative portfolio, now in case of a derivative portfolio, the exposure at default has to change because the value of the portfolio is keeping on changing. So I will treat counterparty credit risk here as a part of the market risk, not as credit risk. So I'm keeping the probability of default more or less constant. I'm not changing the credit worthiness of the counterparty. So the probability of default will be more or less deterministic. Loss given default also we are keeping it as constant. But now we are changing the exposure at default. We are saying exposure at default will change based on the various market conditions. It's completely a stochastic variable. In this case, what we are doing is we are finding the expected positive exposure, which is nothing but the weighted average of all the exposures across different points in time. So when I am taking the weighted average of all the expected exposures across different points in time, that is where I am getting the expected positive exposure. I am multiplying that expected positive exposure with an alpha factor. Right? Now that alpha factor is the value where I am looking at the counterparty credit risk exposures. They are placed on a same level along with loans as well as for derivatives. So based on that I am computing the expected stress loss on a derivative portfolio. Now I get expected stress loss on a derivative portfolio. I got I got an expected loss before stressing. These two will give me the stress loss example. So the expected stress loss on the derivative minus expected loss on the derivative without the stress will give me the stress loss of the derivative portfolio. And we know that this expected positive exposure, it depends on many market variables, because the market variables in turn will typically impact what would be the exposure, what is the change in the exposure. So in turn I could have actually stressed the equity prices or stressed the swap rates, which in turn would change the exposure, because the value of the value of the exposures are typically changing because of the market factors. Exposure at default will be changing, and based on that I could have a completely different number for my expected stress loss. So that is where the stressing can come out by changing the market variables in this example. So when I am treating now CCR as a part of both credit risk as well as market risk, I can very well combine the stress losses that are coming based on the loan portfolio as well as on the derivatives portfolio. I am trying to look at a combined picture by adding all these stress losses together. Right? And finally, one important point in this context, whether a stress loss will overall increase or decrease the expected loss depends on a directional bias of the bank's portfolio. So in some cases it could be an increase, in some cases it could be decrease, depending on who is doing the margin, who is having the excess margin. If I am having the excess margin, then possibly there is an increase in the value of the portfolio, right? Increase in the expected loss. If I have a lesser margin, if the counterparty is having an excess margin, obviously there would be a decrease in the overall decrease in the expected losses of the overall portfolio. Then the other concept that we are bringing in here is stress testing on the credit value adjustment, and I will also talk about the debt value adjustment. Many cases the financial institutions are considering unilateral, means what is the loss that they are going to get if the counterparty is defaulting towards them. So this is a unilateral, but there is a possibility that they also may default to their counterparty. So if I consider both of them into consideration, this is called as a bilateral stress testing or bilateral CVA. But many cases only unilateral CVA is being considered, because many times the companies are concerned that a default of the counterparty towards them, but they don't consider their own case where they are defaulting to their counterparty. If they consider that, then it becomes a bilateral CVA, otherwise it's a unilateral CVA. If you look at the CVA in normal terms, I am talking about the loss given default of a counterparty N, the expected exposure of a counterparty N during this period, multiplied by the marginal probability of default of this counterparty between time period J-1 and J. So I am getting the discounted expected exposure during this particular period, computed under a risk neutral measure, that is this expected exposure. I am taking the risk neutral marginal default probability for the counterparty during this time period and loss given default for this counterparty. Now I am trying to aggregate across all the counterparties. Now this is where the whole thing got added up from 1 to n. I am adding up across all the counterparties. That is the aggregation. Now if you see here, either this can keep changing or this can keep changing. Now if I am considering this variable to be changing for all the counterparties, then I am looking at it from treating CCR as a credit risk, right? Or if I am seeing that this value is keeping on changing, then I am treating the CCR as a part of market risk. So marginal default probability is purely coming, I'm changing these values based on the credit spread. So which means it is coming from the credit risk. LGD is coming from market spread, because if the based on the market scenario, how much amount can be recovered can very well be understood. But expected exposure is purely based on the value of the derivative transactions. Even this is also based on the market variables itself. So now when I am stressing it, let's say I am going with the stress part, I am looking at, so the LGD I am not changing it. Either the expected exposure could be stressed, which is where I am treating it as a market risk, or a marginal default probability can be stressed, looking at it as a credit risk. Now whatever it is, I am computing the stressed CVA, I subtract the normal CVA from it. So this is where we are getting the stress loss associated with the CVA. Just like the way we computed the stress loss associated with the derivative portfolio or even the loan portfolio, here I am calculating the stress loss associated with the CVA. The same logic comes into picture for a DVA as well, right? If I have to look at the complete impact of CVA on profit and loss, I should also include my side of it. So my institution is also defaulting to its counterparties. So what is the kind of loss the counterparty is going to get because of my default towards that party? So here we are not looking at expected positive exposure, we have to look at as expected negative exposure, because wherever the value is negative, the exposure is negative, that is where I can default to my counterparty. So that's the reason I'm looking at negative exposures while DVA. And at the same time, one more thing that needs to be brought, if I have to default to my counterparty, first of all, that counterparty should survive. Otherwise, there is no question of me defaulting to the counterparty. If that counterparty has already defaulted by now, there is no question of me defaulting to my counterparty. So that is where there is some optional part in that. So there is some kind of a dependency on the survival of the counterparty. So some probability associated with the survival also need to be taken care into the consideration. So that's the reason if you see here, first thing, loss given default for the counterparty, right? What is the loss that I can recover when my counterparty defaults? Multiplied by the expected exposure at default of that counterparty, the marginal probability default of that counterparty, and the probability that I am surviving before my counterparty defaults. I might have already gone out of business. So I need to consider this as an additional variable when I am computing the bilateral CVA. Similarly, the loss given default to my counterparty if I default. I is the institution which we are measuring this. Similarly, expected exposure expected exposure of the counterparty, expected exposure expected exposure to the counterparty when my firm is defaulting. Then I'm also, so here expected exposure I can keep n itself because I'm taking the negative expected exposure, so I don't need to change this. Wherever negatives, I'll try to do the weighted average value of that. Then marginal probability of default of my institution to my counterparty multiplied by what is the probability of survival of my counterparty at that particular point in time. So all these are added across all the counterparties, and this is what will compute the bilateral CVA. So here if you see, the probability of default is not changing. It's only the expected exposure or the loss given default that is getting stressed in the process. So which means I am treating the counterparty credit risk as a market risk itself. As long as the same shocks I am giving to the market variables and the same shocks are given to the trading portfolio as well as to the bilateral CVA result, I can very well aggregate them across the various counterparties quite comfortably. And finally, looking at the common pitfalls in stress testing, it's very rare that the counterparty credit risk can be aggregated with stress tests of the loan portfolio as well as stress tests of the trading positions. Whereas now with the various technologies coming into picture, this integration needs to be done, which is when the full picture can come out quite comfortably. But the most serious problem is this. See, majority of the financial institutions, they do stress testing on the current exposure. So what they generally are tempted to do is, whatever the stress testing result that they got on the current exposure, they'll use those results and combine the losses with the loans, future loans and trading position. But one thing we have to understand, for exposure, it's better that I use expected positive exposure, not the current exposure. Right? For computing the CCR, I should use the expected positive exposure, which comes from the future time periods and weighted average of the expected exposure at the future time periods. So that's one common pitfall. Similarly, companies keep using the delta sensitivities to calculate changes in exposure. They treat it as a linear, but many a times it is highly non-linear. So there are so many errors that come up which are not even obvious, and they can be highly misleading, especially when you work with at the money portfolios. You will find large movements in the errors when you are using delta approximation. So you should be very careful when you are doing the stress testing computations based on the counterparty credit risk. So these are some of the topics that I wanted to cover as a part of this session. Any further queries you have, you can very well get in touch with me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.